Home Depot dropped roughly 2% today after filing its Q1 2026 10Q this morning. A report that landed without good news on the two metrics investors watch most: comparable sales and gross margin. Home Depot is trading at $317.85 as of this recording. The filing covers the quarter ended May 3, 2026, and it's already prompting fresh debate. Motley Fool ran a piece today asking which is the better buy right now, Lowe's or Home Depot. And the Q1 numbers are exactly why that question is being asked. The short answer from this filing: margin pressure is real, the housing backdrop remains difficult, and guidance language is cautious. Home Depot runs roughly 2,300 stores across North America and splits its revenue between two customer types: DIY consumers doing their own remodeling work, and pro contractors, plumbers, electricians, general contractors, who account for a disproportionate share of the high-ticket spend. The pro segment is the growth engine. When housing activity slows, the pro segment is the first to feel it. Since late 2024, existing home sales have been under pressure from elevated mortgage rates, which suppresses the turnover activity that drives large remodeling projects. That's the backdrop walking into this quarter. Tariffs are the second structural headwind. A significant portion of Home Depot's product mix, power tools, appliances, fasteners, lighting, is sourced from China or runs through supply chains exposed to the tariff schedule that escalated through 2025. The 10Q's management discussion flags tariffs as an active cost driver. The mechanism is straightforward. Higher input costs either get passed to the customer, compressing unit volumes, or get absorbed by the company, compressing gross margin. In Q1 2026, the filing indicates both are happening simultaneously, a margin squeeze from two directions. Comparable sales, same-store sales growth, the single most watched number in retail earnings, is where this quarter disappoints. The 10Q shows comparable sales tracking below the trajectory needed to support prior full-year guidance. The filing does not frame this as a temporary blip. Management's discussion points to consumer hesitation on large-ticket discretionary projects, a category that historically moves with housing turnover and homeowner equity confidence. When mortgage rates stay elevated and home prices stop rising, homeowners delay the $15,000 kitchen remodel. That deferral behavior is visible in the comp number. Gross margin in the filing reflects the tariff and labor cost dynamic directly. Labor costs across store operations and the supply chain network. Home Depot has invested heavily in distribution infrastructure since 2021, are running above prior year levels. The combination of higher product costs from tariffs and higher fulfillment costs from labor produces a gross margin line that is moving in the wrong direction. Management acknowledges this in the 10Q's MD&A section. The key question for analysts now is whether this is a one-quarter reset or whether the full-year gross margin target needs to come down. On full-year guidance, the 10Q's forward-looking language is the most cautious read of the filing. Home Depot has not issued a formal upward revision, and the qualitative framing around macro conditions, tariffs, housing activity, consumer confidence on big-ticket spend, creates meaningful uncertainty around whether the original FY 2026 targets hold. The filing stops short of a formal guidance cut, but the language gives management room to revise downward in Q2 without having technically misled investors in Q1. That's a well-recognized pattern in 10Q filings when management sees deteriorating conditions mid-cycle. To put Home Depot's move in context, the broader market is not under stress today. SPY is at $750.46. The VIX is sitting at 1629. That's not a fear reading. Home Depot's sell-off is isolated, not a macro event. That actually makes the earnings read more informative. When the tape is calm and a stock drops 2%, the filing is doing the work. This is the market repricing the stock on the actual numbers, not on broad risk-off flows. Three things to monitor from here. First, the Q2 earnings call. That's when management will either defend the full-year guidance or formally revise it. Second, watch Lowe's when it reports. Lowe's operates the same macro exposure, and if they show similar comp and margin trends, it confirms the headwinds are industry-wide rather than Home Depot-specific execution. Third, watch housing data. Existing home sales and housing starts from Fred. If those turn higher, it would provide a genuine demand tailwind for Home Depot's Pro segment and large ticket categories. Until then, the Q1 filing sets a cautious tone for the rest of the fiscal year.